The impact of social media on the synchronization of investor decisions. Fundamental analysis is based on a comprehensive understanding of the macroeconomic situation of a given sector and on gaining insight into the economic and financial condition of individual issuers of securities. It is impossible to predict stock market events by looking solely at a single entity in terms of its financial performance while ignoring the needs or expectations of all market participants. Some participants will be guided by emotions or limited information, or as a result of manipulation occurring across various information channels, including social media. The communication process has expanded to include new data sources, such as financial portals, investment blogs, services for experienced investors, discussion forums, and social media. In research, Twitter is by far the platform dedicated to assessing market sentiment. Approximately 50% of the content there, rich in unstructured data such as text, images, or videos, can significantly contribute to the creation of predictive models. A drawback of relying on social media is that anyone can be a source of information, including individuals with limited data, knowledge, experience, and psychophysical abilities. There is also the issue of apparent anonymity online, which can lead to a distorted view of the market. Social media users are also susceptible to a phenomenon known as herding. In such cases, investment decisions are not driven by cool, rational judgment or specific, direct knowledge of a company's operations, nor are they dictated by an analysis of the factors shaping specific market outcomes, but rather by the influence of a given community's persuasion through online posts and messages. This is precisely the approach taken by the aforementioned researchers Chen, Yo, Lau, and Li, who used neural networks to predict stock index movements based on content published on social media. Which plays a greater role? The data source or the data transmission channel in investment decisions? In information theory, behavioral economics, and complexity theory, both of these parameters are important, but their significance varies depending on the situation. The data source is the primary generator of information, and it is definitely worth considering companies' quarterly results, reports, or inflation data. On the other hand, choosing the right data transmission channel allows you to narrow down the results to the most optimal group of experts on whom to base your predictions. Interestingly, information conveyed through different channels can have a completely different emotional impact, even though the macroeconomic information is formally identical. In their work, they analyzed the impact of news published on social media, particularly on the Chinese platform Weibo on stock market index behavior. They used natural language processing NLP methods and RNNs, recurrent neural networks, to examine the relationship between user sentiment and future market movements. Their results suggested that information and emotions disseminated on social media can improve the accuracy of stock index forecasts. More prominent users influenced asset price movements over short periods of time. Interestingly, the model developed on Yahoo Finance yielded better results in predicting increases in security prices than standard technical analysis. In the case of cryptocurrencies, negative sentiment in social media content correlated most strongly with price changes. These were mainly currencies such as Bitcoin, Ethereum, Monero, Ripple, Electroneum, and Zcash. When it comes to financial education and relying on the predictions of other market participants, it's worth considering whether a given person truly specializes in that particular asset. Social media can be effectively utilized in a portfolio strategy as long as it is approached with a degree of caution. Research shows that only a fraction of active analysts posting on social media generate above-average accurate forecasts, and their effectiveness often stems from specialization in specific sectors or asset classes. If someone is looking for their niche in cryptocurrencies and wants to base their portfolio on that, they should, for example, check out Willy Woo's channel, while those interested in the real estate market and systemic trends should visit Michael Berry. Depending on which educational group uses information from online sources, differences can be observed in preferences and in how social media is used for investment. Individuals with an economics background strongly prefer established financial websites and base their investment strategies on them. In the case of self-taught individuals or those without an economics background, these people are more engaged in sharing their predictions on discussion forums. Unfortunately, this information is generally not obtained from experts. Noteworthy is an emergent phenomenon occurring on Platform X some time ago. While Twitter was still active, the FinTwit community formed an informal community of investors, traders, analysts, economists, investment funds, and financial journalists centered around the platform. This community functions as a single system that interacts with itself according to the theory of emergence. This means that the complex behavior of this ecosystem arises from simple interactions among its participants. No single user controls the community, but interactions based on market behavior analysis build shared expectations, collective emotions, and fluid waves of optimism and pessimism. One of the most famous examples of social emergence in the markets is the 2021 GameStop short squeeze. By exchanging opinions, investors reinforced a single narrative and encouraged one another to buy. This action gave rise to a collective investor movement that led to a sharp rise in GameStop's stock price. No single participant planned the entire process, but global market behavior emerged from local interactions. It is also worth mentioning the power of automating the investment decision-making process, developing appropriate software to analyze index movements on individual stock exchanges, and the ability to use programming libraries such as Python to monitor the activity of individual stock market investors gives the informed investor a significant advantage. Analysis of the impact of social media on financial markets is most often based on collecting large sets of posts, identifying sentiment, that is sentiment analysis, and examining the relationship between user activity and changes in asset prices. Important tools include the Filtered Stream API for retrieving posts in real time and the Metrics API for tracking engagement statistics. Natural language processing tools can enable the analysis of market trends by classifying vast amounts of posts. I recommend tools such as Hugging Face Transformers for this purpose. To properly analyze social media data and determine whether sentiment influences the market, it is always necessary to have price data and to examine the relationships between users. Once sentiment is combined with price data, appropriate predictive models are built. This is precisely the approach taken by the aforementioned researchers Chen, Yo, Lau, and Li, who used neural networks to predict stock index movements based on content published on social media. Which plays a greater role? The data source or the data transmission channel in investment decisions? In information theory, behavioral economics, and complexity theory, both of these parameters are important, but their significance varies depending on the situation. The data source is the primary generator of information, and it is definitely worth considering companies' quarterly results, reports, or inflation data. On the other hand, choosing the right data transmission channel allows you to narrow down the results to the most optimal group of experts on whom to base your predictions. Interestingly, information conveyed through different channels can have a completely different emotional impact, even though the macroeconomic information is formally identical. The market does not react to what has happened, but to how quickly and widely market participants learned about the event. In the long run, however, long-term investors rely more on data sources than on communication channels because the market always returns to its fundamentals. For short-term investments, information channels become crucial for ongoing market analysis. In the case of long-term investments, a well-researched data source curated by an expert becomes a sine qua non as input for any technology-driven actions. Thank you for listening to the insights shared in this video. I hope you invest your time in meaningful activities and learning. Bye.